Smooth 98.1. Love music, love life. Welcome if you just joined us here just in time. It's time for Business Express 981. It's a Tuesday today. And of course, leading us through conversations as always is Rotus. Today, we're going to be talking about the banking sector. We've got a very special guest as well. But Rotus, good morning. How are you doing?
I'm fine. Good morning, Kayode. Good morning to all our listeners, and good morning to Oluwadara Olunuga, investment analyst with ARM Securities. Dara, good morning to you as well.
Good morning, Rotus. Good morning, Lagos. Thank you for having me.
Great stuff. Great stuff. So, Kayode, how can people join?
Yes, definitely. So if you're out there and you want to be a part of our talk, please send your messages to 0809-444-0981. Let me see that slowly. 0809-444-0981. Rotus?
All right. So yeah, look, we've been reviewing different sectors. Yesterday on the marketplace in the app, we're looking at the agricultural sector. And so today we're going to be looking at banking. And so I want to just review the banking sector with Dara. Dara, as we look back on the banking sector in Nigeria for fiscal year 2021, how would you say it has fared?
Okay, I'll say the word is resilient. Honestly, the bank sector has sort of remained strong and resilient, in the face of a lot of regulatory bottlenecks from the CBN, the LDR, mandating banks to lend like 65% of their books to the real sector, while about 40% of the deposits is being constrained in CBN vaults as CRR, and interest rates that have been relatively lower. The banks can really just play at the short end of the market, and interest rate there has been very low compared to inflation. So imagine if 40% of the books have been quarantined, they have to lend 60%, they still have to invest the rest in a very low interest rate environment. So all we've seen across the banks, especially over the last 9 months that we've seen earnings highlights, is the fact that interest income has declined, across the banks majorly. It's been a game of survival between the balance sheet that has been quarantined and, the interest rate environment that is not so favorable. But the only silver lining that I would say for the bank's profit and income statement has been the fee and commission income. There's been during the pandemic, there was a lot of emphasis on e-banking activities, and that has spurred the fact that when you go to a bank now, you probably have to wait for hours to get checked in with your nose mask and every other thing. So that's spurred people to start transacting online. And we check the statements across the bank, you see that fee and commission income has greatly improved, and especially from the income from the e-banking business. And what we've seen is that from 2019-2020, CBN sort of regulated that space, and there was a decline across board. So we're seeing a recovery from the base effect and income from that line, bolstering income, cushioning the decline that we're seeing in interest income. Another thing is, the FX adjustments that we saw in 2021 was favorable for some of the banks, especially Tier 1 banks that had a net FX asset position. They were able to rake in, evaluation gains from that line and boost bottom line. So, but I would say it has been resilient so far. There's been a lot of regulatory bottlenecks, fighting for the bank's balance sheets and, constraining growth in profitability. But we've seen the bank sort of pushing this growth from trading gains, fee and commission income, and evaluation gains, as we've seen over the last 9 months.
Great stuff. What about the extending credits to the real sector? I guess the real sector has always been about lending and so on. How would you review lending to the real sector in 2021 from banks?
Yeah, so lending to the real sector actually improved in 2021. Like I mentioned, the CBN has adopted the stick approach in ensuring that these banks lend. So it's a conundrum of you either lend to the real sector or you have to quarantine 50% of what you don't lend out in CRR, earning 0%. So that stick approach has sort of bolstered and improved credit to the real sector. In 2021 alone, we've seen credit to the real sector improved by about 2 trillion naira as at 9 months numbers. And that is what the CBN is always capitalizing on, that the regulation has been sort of favorable. But when you look at the breakdown of the loan, about 20% of the loan still goes to the oil and gas sector, 19% to the manufacturing sector, and other sectors are just grappling for the rest. Coupled with the fact that lending to government is another thing. So we've seen that although LDR has been stipulated at 65%, but across the industry, the average is currently about 57%. That's why you see that on a monthly basis, you still see CRR debits from the CBN quarantining 50% of the excess shortfall that the banks do not lend out. And some banks are in a comfortable place, allowing the CBN, quarantine this fund because of the riskiness associated with lending to the real sector. So banks would rather stay in a comfortable place, lend to oil and gas businesses, maybe in foreign currencies that puts them in a very good position in terms of net FX assets than just lending to a businessman with no track record, and with infrastructural issues that we have in Nigeria affecting the growth of businesses.
All right, thank you very much for that. Let's talk about extending credit, for example, non-performing loans as well. Now you've talked about how the banks are lending to different sectors, but how do they keep that under control? Because if they lend to as many people as possible and then they don't pay back the loans, what then happens?
Okay, so what we've noticed is that over time, there's been a lot of emphasis on reducing non-performing loans to the 5% threshold. The CBN has this benchmark that non-performing loans should not exceed 5% of your total of your gross loans. So what we've seen is that across, as a 9-month numbers, across the industry, the numbers are like 4.5, less than 5 point benchmark. So what I suspect is that banks are lending, but they are being careful. As you can see by the LDR, that is still less than the threshold, even after 2 years of enacting of them putting that regulation in place. What I suspect is that businesses are now looking to fintech borrowers, fintech opportunities, which all these advertisements that you see on TV that people can borrow within 4 minutes, 5 minutes, and that is where businesses are now looking for instant, all these very fast and quick loans. Because by the time you check the books of those fintechs, insider information reveals that the non-performing loans in that side is quite high. But for the banks that are being regulated, I think they're keeping that in check with their effective risk management procedures.
All right.
Great stuff. Darren, why still on lending? Lending is the big thing. Why are interest rates in Nigeria still so high?
Well, it's commensurate with the riskiness of the economy, to be honest. So, you can extend credit to a sector for as long as you want to. Take, for instance, the agriculture sector has enjoyed, all these policies, all this funding from the CBN over time, 40-something billion in anchor borrower, 400-something billion in commercial agriculture credit scheme. But what do we have in terms of outputs? What is the sector contributing to growth? To export, the export basket is still very, very much, very, very, very low in terms of agriculture. So you can extend credit to a sector, but if the sector is faced with bottlenecks like we have in Nigeria, power issues, road transport network, where and people that cannot even clear their goods from the port. So you extend money to a businessman that takes 20-30 days to clear money from the port. How is that working capital cycle going to be managed? If I can get money and 20 days, I've not even received the goods that I'm supposed to sell to be able to repay the loan. So it's the loan, the interest rates that the banks request of businesses is commensurate with the riskiness of those businesses. And banks are in business to make money, as much as you want to say it. You may be a shareholder in a bank, your business is to make profits from your holdings in the bank, not to do a charity or to help the economy grow. So banks are in for money making. If the economy can be de-risked, if all of these bottlenecks can be resolved, then you will see more favorable interest rates. I mean, banks prefer to even sometimes go to put money in investment securities that are less than inflation rates, that lend at 20-something% because it's too risky. It's too much of a stress to start chasing down borrowers.
All right, thank you so much for that, Saludar. If you're out there and you want to add to our conversation, please send your messages to 0809-444-0981. That's where you can send your messages to. I'll say that one more time, 0809-444-0981. This one from Ogane Ochuko says, why won't the Nigerian banks lend to the informal sector with a single interest rate? Rotus, you want to take that?
Well, it's just what we're talking about. But Dara just answered the question. But Dara, you can take it again. Why they can't lend to the real sector at single-digit rates?
Okay. It's a two-part thing, right? There's the part of the economy and the government, and there's part of the businesses. So in part of the economy is what I just highlighted. People can't clear their products from the port in time. They can't get it across to customers in record time because of traffic, bad road network. There's electricity. We don't even have enough preservative facilities from farm to market in the case of the agriculture sector. So that is the part of the economy and the government. And government constraining a lot of sectors. Whatever happens with ride hailing, businesses cannot even thrive easily. If you see a sector thriving, there's a regulation that just comes up and, sort of dampens sentiments in that market. And of course, on the part of the businesses, like you mentioned, the question says informal sector. How many informal businesses have adequate records with which I, as a bank, can track what you've done over time? Can you articulate what your revenue is? Can you articulate profitability? We've seen businesses meddle personal affairs with businesses. They can't even separate bank statements for some business. So when you're talking about businesses, you want to talk about established business that have track records that can show the banks that over the last 5 years, I've grown my revenue by a cumulative annual growth rate of 10%. Yes, that is what I want to hold on to. What has profitability done? What are your margins? You can speak to them without, you consulting anybody. This is your business. This is something you should have at the tip of your fingers. So if the economy is not helping you in terms of infrastructural problems, and you are not helping yourself by having adequate records to show the banks that you are creditworthy, then the banks have no choice but to put a premium on the interest that's going to be charged to you, and then use the single digits. I'd rather, as a bank, go to the market and get single digits on my treasury bills and sit comfortably in my jacket and be comfortable. I'm going to get my 6% at the end of the day, than lend to you with all of this stress and start looking for you when it's time to pay and start looking up your shop or something. Do you get?
I get strong, excellent breakdown there. You mentioned the cash reserve ratio earlier. Is there any scenario where that can be? I remember there was one shareholder association that said it should be reduced. What do you think about that? Is that even possible?
Yes, it's too much. The official rate is at 27.5%, but effectively, CRR for some banks run into like 50%. As at half year, GT Bank's investor conference, it was stated about 500 billion of their assets, that is like 5 trillion assets, is seated in the CBN vaults and earning 0%. I would agree with shareholders that would clamor for that, because for some of these banks, they are not able to sweat these assets and they are paying interest expenses on this. So imagine you are borrowing from the public in terms of deposits, you're paying interest expense on it, and the CBN is holding it at 0%. You're not earning anything. So it's net, you're not in a comfortable position. So the CR ratio is very, very high, even as an official rate, not to talk of the effective rate of about 50%. So I would also advocate that this rate should be reduced. That is, if the CBN is saying is in an expansionary mode, supporting economic growth, then we should reduce this rate and, ease the pressure on the banks to, generate interest income and improve bottom line at the end.
Got a few messages here. Let's quickly jump to those messages before we wrap up this side of the show. This one says, do banks consider inflation rates when computing lending rates? This is Francis. This one from Oyenye Obijaku says, government should sort out power and infrastructure and rates will come down. Also, here's another message from our YouTube platform, by the way. We're streaming live on YouTube. So if you're out there and you want to, catch a glimpse of the show, please head on to youtube.com/smooth981. This one from Michael Aditutu says, hello team. No bank has been able to keep their NPL below 5% due to the LDR. What they do is restructure to be able to keep it low. In spite of GSI, the NPI across board is high because of the GSI, because the GSI is not effective and it hasn't been used. So
okay, wait, so many, very quickly, I beg, LDR, loan deposit ratio, right, Dara?
Yes, loan to deposit ratio.
And then what's NPL, please, for our listeners?
Non-performing loans.
Thank you. Just so many acronyms there. Also, just help.
Exactly. So many acronyms.
How many questions we're out of time? How many can she answer? Can she quickly just answer one?
Yes,
question?
I'd rather you just summarize all three, please.
Okay, so I'll just take the first one, saying, do they consider inflation? Sure, they do. They consider inflation, in lending. But what you see is that the alternative that they have in the financial market does not compensate for inflation rates. At the long end of the market, the rate is like 13%, and bank cannot even play at the long end because of the asset liability management structure. So they consider inflation, but if the economy can be de-risked, like I mentioned, the banks do not mind lending at 13% rather than go to the T-bills market and get 6%. Does that make sense? They consider inflation and say, they put a premium on inflation for businesses. But if these businesses can be de-risked, like you mentioned, all of these factors taken into consideration, and people can access loan and repay on time, then the banks do not mind giving a 10% to a loan to a business that is viable and go to the treasury bills market to get 6%. That puts them in a better place in terms of interest income. And I think the other thing about non-performing loans, please, official numbers as audited numbers for half year states that non-performing loans, the only banks that have non-performing loans above the 5% threshold is First Bank and Guarantee Trust Bank and then Eco Bank. And EcoBank is a Pan-African bank, not just Nigerian operation. So you can't generalize to say banks can't keep non-performing loans below 5% because of LDR. So that's why I said they've been lending, but they are not expanding as much as CBN expects. That's why you see that LDR is still at 7% compared to 65% that the CBN has mandated since 2019. And that's why you are seeing the CRR debit. So if they're not lending enough, the CBN keeps quarantining 50% of the shortfall. That's why every month CBN comes to quarantine the shortfall because they are not lending enough. So the risk management procedures are still in place, even in the face of expansion in credit. I don't know if that makes sense to the person that asked.
It does.
All
Excellent.
Right. Thank you so much.
Fantastic breakdown. Fantastic. Dara Luniga, investment analyst, ARM Securities. We didn't get to stocks, but you guys, ARM has an app that you can use to purchase banking stocks. Maybe we'll get into that next week. But Dara, excellent segment. Thank you so much. Great breakdown. Kayode is giving me the hand signals.
Thank you.
Your questions. Great segment. Thanks, Kayode.
Thank you so much, Rotus. Thank you so much, Dara. Lagos, there's more to come.
Thanks, Kayode.
So please stay with us. This is the smoothest style of Lagos radio. This is Smooth 98.1.